Well, good morning. Welcome to What Should I Do? Top 5 Priorities for Your Business. Now, for many of you, you sat through this program yesterday, and maybe I looked a little bit different. Well, we wound up with a little bit of a technical glitch where the recording didn't come through the way that it was supposed to. And so we came back into the studio this morning real quick just to go through the entire thing again. So you'll see a couple little differences. Maybe my stories aren't exactly the same, but it's the same content, same program that we ran through live yesterday. So with that, let's go ahead and get started. Really, we're focusing today on, again, what are those priorities? What are the things that we really need to be focusing on within our company? And there's some things that many times don't receive the attention that they should, and they are a priority. And we stop and think about, what are some of these items, and why don't we really get into and follow up on them and focus on these priorities if they're that important? For a lot of cases, a lot of us, there's just no time. I'm way too busy to stop and try and do some of that planning, those planning things that we need to do within our. For others, you know what? I've just got so much to do in my daily routine. Again, there's just no time here. For some of us, quite honestly, some of you have very large teams, and I've got individuals who can focus on different areas within your individual company. But for others of you, you don't have it. It's just me. And I have to do everything. And so I don't have time to get all that stuff done. Yeah, I get that, right? And for others, it's the people problem, right? Some of you deal with the adult daycare thing going on, right? You come in every day and all these employees, right, come in and dragging their problems with them, and we got to run the daycare and do that. I get that, right? I understand that. And for some of us, it's actually a little bit more than that. It's, look, I've already got financial problems. I'm too busy trying to just keep the cash flow going, right? I'm out there too busy losing money to stop and figure out why I'm losing money. And so, all of these things factor in. Every case, these are critically important that we take the time to focus on these top five priorities. So, with that, we stop and think about, okay, why, really what are the top reasons why we have issues, why we have problems within our companies. And really, the top two problems, the main reasons why companies go out of business, it's actually very simple. Number one, improper labor pricing. Now, that sounds so basic, so simple that, we should have that one figured out. But it's so foundational. It is so critical. And it's the number one reason why companies go out of business. They don't charge enough for their products or services to support what it costs to run the company. But even if you're charging exactly what you need to charge, many companies still go out of business due to poor cash flow. You can be charging exactly what you need to and still go out of business because of poor cash flow. So we need to be looking and focusing in those areas, and they certainly fall into these top 5 priorities as we start looking at it. So let's jump right in. We've got a lot of material to cover here in this next hour, so let's kind of dig right into it. Number one, you have to know your numbers. You have to know the numbers of your company extremely well. And for many of us, especially if we grew up in this business or in this trade, whatever it is, right, then we're too busy. We're doers, right? We know that short of anything else, I can go out and do something. I can install something. I can sell something, and that'll help us. That'll put a Band-Aid on it in some cases, but you have to know what your numbers are. And so one of those key points is knowing exactly what you need to charge per hour to run your business. And your labor rate needs to cover all the real costs of doing business within your company from a cash flow perspective. Not an accounting side. We'll talk about that as we get into here. Your P&L will lie to you every day of the week. You have to run your business based on the cash flowing into and out of your checkbook every day. So we need to know exactly what that number is. You also need to generate, that labor rate needs to generate a significant pre-tax net profit. And let me just say this, it's not profit until you've been paid and until you've paid all your suppliers. So we're going to come back and talk about those two items as well. Now, an accurate labor rate is the basic building block for profitability. Short of having this, it's the cornerstone. Without this, the rest of the company will crumble. So we have to have that in place. The number one failure that most companies today have is the failure to recalculate the profitable labor rate on a regular basis. Maybe we attended a program 2, 3, 4 years ago and we established the rate that we needed to have. And we just tack on another $1 an hour, here and there just to kind of keep up with where things are at. That's a problem. That's a major problem. Or worse yet, maybe we're charging ourselves. The number one method of setting pricing across the nation, across all trades, is find out what everybody else in town is charging. And, I don't want to be the high guy. I don't want to be the low guy. Well, sometimes I do, right? But we want to be a lower. We really want to be competitive on that one to make sure we get the business. Because now we wind up with the guy who understands business the least dictating what you're going to charge per hour. And my question to you is always, what does what the guy down the street is charging have anything to do with what it costs you to run your business? Absolutely nothing. To be looking at those couple of items, we need to review this labor rate on a regular basis. Now, chances are, along with that labor rate, it's not just one labor rate for the company. It's several labor rates because you have to departmentalize your company. And so we look at that, initially when you went into business, whether it was 2 years ago or 20 years ago, or 75 years ago, initially chances are you did one thing, right? We did just service work. We did just add-on or replacement. We did just new construction type work. It was easy. It was one thing. Now we do kind of all sorts of things. And it's very common, very simple to have one department subsidizing another, and we never even realize it. Because what winds up happening is every time a customer pays us, we deposit that check in the checkbook. Every time a vendor sends us an invoice, we write a check out of the checkbook. And as long as there's still money in the checkbook at the end of the week, the month, the year, whatever, we think we've done okay. May or may not have done okay. So we need to departmentalize your company. You need to look at that. Let's take a little bit closer look at that from a very simplistic standpoint. If I look at, in my company, right, if I'm doing $1 million in gross sales, my total cost of materials is $300,000. My total cost of labor is $200,000. And then all overhead combined, this is, again, a very simplistic look. So, again, it's everything. It's all cost of goods sold, permits, overheads, everything is $350,000. I finish up the year at $150,000 profit. Comes in looking like a 15% net profit. Did you have a good year or not? If we look at it a little bit more granular, look at it a little bit deeper, we can see that here's my service department. I'm making $80,000. My new construction is losing $20,000, and my add-on or replacement or retrofit is making $90,000. There's $150,000 profit, even though I've got one department sucking $20,000 out of the company. That's going to be a problem. Right? Could I make this department break even? Right? Or should I just get rid of it altogether? Now, be careful on that one, because you do not want to just simply eliminate a department that's losing money. If we look at that a little bit deeper, we can see here that in service I'm making money, in retrofit I'm making money, and in new construction I'm losing money. Well, if I'm losing money for all that work, why don't I just get rid of it? Well, if we're going to get rid of new construction, one of these numbers goes away. Which one of them disappear? Well, if you think about it, of course, the sales are going to go away. That $200,000 will disappear. That's gone. Then on top of that, all that labor, that's going to go away. Now, the challenging part or the typical thing that happens is, yeah, but we got Joe. Joe's a good guy. I like Joe. He's been with me for a long time. Joe's got kids. He's got a family. I can't let him. And so we'll move Joe over into one of the other departments, and we never actually get rid of all of it, which only makes this problem worse. But for the purposes here, we'll say that we got rid of all $60,000. The materials, that equipment that we're buying, that's going to go away. We don't need to buy that anymore. And then the department-specific overhead, that's going to be things like fuel in the trucks, maintenance in the trucks, stuff like that for that new construction department. That's going to go away. But what about the general overhead here? This general overhead, the $48,000, that's the rent in the building. That's the insurances. That's the telephone bill. That stuff doesn't go away. So what happens to that $48,000? It has to be pushed over and covered by the other two departments. And so when we look at that part of it, if we get rid of that and move it over, now we wind up with all departments losing money. That winds up becoming a problem. Can we make it at least break even? If we can make it break even, again, that's a huge plus. Even if we're not making money in that department, because think about it, at that point, it may be providing a significant amount of work for the other departments. Right? New construction, in this case, very well could be providing additional service work and eventually turning into add-on or replacement type work. So that very well could be the case. It could be covering, as we just showed here, it's covering a significant portion of our overhead expenses. Does it make sense for me to back out of that one? You have to departmentalize the company. Now, one of the questions comes up is, yeah, but what's a department? And so, with that, we look at it, a department is considered a separate department if, A, it makes up a significant amount of your overall gross sales, at least 5% minimum. If it doesn't make up at least 5% of your overall gross sales, it's not a department, it's a hobby. Blend it in with something else, one of the other departments, right, and just group it there and move on. If it's at least 5%, that would be a separate department. Second criteria would be that it has it could have its own unique hourly rate. So, for example, some of you do both residential service and commercial service, and we charge different rates for each. Well, if that's the case, you could at that point split those into two separate departments. Again, we want each department to be profitable in its own right. I don't want another department to have to subsidize and cover the costs of another department. So we want to keep that in place. Now, one of the questions that did come up during the live classroom session yesterday was on departments themselves. When we look at that with the departments, what do we use to track that? Because it can be kind of an unruly monster to keep track of. Let me just say, again, there's a lot of different software programs that are out there, a lot of different software programs that are available, and there's really not a right software program that I can recommend for you because I don't know the structure of your company at this point. One of the things that happens, each one of you, some of you use different accounting software programs, and I want to keep using my accounting program, right? 85% of you use QuickBooks. Right, so I want to keep using that, but I just want to manage the rest of it. In other cases, we want to graduate beyond what we're using today, or we want to shift away and use a fully encompassing software program, which will handle everything from the accounting side to the dispatch to the management of the projects and things like that. And so it's going to vary from company to company. The other thing is, keep in mind, I'm not telling you that you have to change the way you're doing your accounting. I am telling you that you need to look at your company from a departmentalized standpoint and see, okay, what should I be charging in each department of my company? Now, having said that, our labor pricing for profit software does a great job at helping you plan forward. Your P&L lets you look backwards. The labor pricing software will let you project forward 12 months and break your company up into individual departments to find out what do I need to charge in each type or each department of my company. Then, if you want to continue using your accounting software in one department type format, I'm totally good with that as long as you're charging what you need to charge in each area of your company. So that's the first criteria that we need to look at there. Now, again, know your numbers. This is still priority number one. So again, charge what you need to charge. And again, your labor rate needs to cover all costs of running your company from a cash flow perspective. And that, again, is important. There's a major difference between cash flow and accounting. And we'll talk about that when we hit priority number two. But it's a critical item to look at. Again, some of the things that need to be factored in there is your equipment replacement costs. Equipment replacement costs typically are not in your accounting side. Your accounting, your P&L will show you depreciation. Depreciation is an accounting thing. I mean, think about it. When it comes time to replace your truck, what does that depreciation do for you? Absolutely nothing. It's not like you can take that depreciation statement down to your local dealership and say, here, what do you give me for it? There's nothing there. Right? So that's the first thing. So when we're dealing with factoring in equipment, your equipment replacement costs, the cost of your trucks, the cost of your major pieces of equipment, that is the single greatest expense you have in your company. Second greatest expense. Yet, when do most companies start to plan to replace their trucks? When we're sitting on the right side of the road and the truck's dead and we're going, okay, now what are we going to do? Right? So that's one of those issues. We have to be factoring that into our pricing. When we're looking at listing and coming up with this value, it's all pieces of equipment over $1,000. So we're talking about things typically like trucks, vans, flatbeds, job trailers, trenchers, backhoes, if you have some of those things, depending on your trade. High lifts might fall into that category if you own them. Any of those items, right? It could also include things like, computers. Now, I'm not talking about a workstation. We just picked up one of those around here recently. It was something like $500. We're talking about a server. Whoops, and think about it. If computer. We don't like to, as contract, many times spend money on computers because they don't make us any money. But think about it. What happens when your server or computer stop working? You're not making any money, right? So keep that in mind. That should be, right, if you have an internal server, right? When you're replacing that, it's not just the server itself. Usually then it's software I have to upgrade and other things. I think the last time we upgraded ours were something like $12,000, $10,000, somewhere in that range, right? That would be on my equipment replacement list because it's going to happen on a regular basis. So include those items. It could be things like large copy machines if you own them, right? Shop equipment, maybe I want to put in a plasma table, whatever the case is. For some of you in your trades, it's the inspection cameras. Those things are several $1,000s. Those would go on these lists. They need to be replaced periodically. So factor those dollars in. How much money do I have to put aside each year so when it comes time to buy them, I can do that? So that's the first piece on the numbers. Next one is field labor. Now, field labor, again, it's interesting. You ask any group of contractors, as I'm doing my training, I'll ask them, what's your single greatest expense? Then I always get the answer, it's labor. Well, more specifically, it's a subset of labor, right? So field labor is the guys who are in the field doing the work. They work an hour, I can bill somebody an hour. Now, when we're dealing with field labor, we also have to talk about non-billable time. That's your number one expense. Not just labor in general, but specifically non-billable, non-chargeable labor. That's your single greatest expense that you have in your company. Right? This is extremely expensive, and again, Joe may go out and work, and bill out 20 hours this week. Something has to pay for the other 20 because he still wants to be paid for it. So somehow that has to be covered and needs to be built into our labor rate. Right? So know what your guys are billing out. It all comes down to the billable hours. All of your expenses have to be spread across your billable hours. Now, what's typical for the single greatest expense that in this area that business owners will make is they think our guys are billing out more hours than they actually are. The typical service tech is about 50% non-billable. The typical install crew is somewhere around 30% non-billable. And again, a tech is going to be a lot more because they got a lot more windshield time. They're hitting more jobs in a day, whereas an install crew goes out to the job, stays on the same job for a much longer period of time, maybe all day even. Right? The chances are the install crew knows what they're getting into when they go out to the job, so they have the materials and they have everything else with them. The service tech, on the other hand, goes out and every job's a new adventure. Right? He doesn't know what he's getting into until he gets to the job, and then okay, I don't have that material, so I got to go get it. So it's a lot more challenging at that point. If you're not tracking non-billable time, chances are it's a lot higher. So keep that in mind as you're going through that. Factor that into your hourly rate. And then materials. You have to know your numbers. And so the question that I ask you is, do materials and material pricing play a part in your labor pricing, in your labor rate? And we asked the question during the live seminar yesterday, and a whole chunk of you said, no, they're separate. There was a number of you said, I think it impacts it somehow, I'm just not sure how. Right? And some of you did say yes, and we had a couple of you that were honest and said, I'm not quite sure. There's no question about it. Your materials and your material markup have a direct correlation to your labor rate. If we look at it, your company as a whole has a certain amount of overhead that it has to cover. I don't care if it's going to come from material markup or if it's coming from labor, but it's got to be covered somehow. Right? If I'm going to discount my materials, then I have to increase my labor rate to make up the difference. If we're going to, increase the material markup, right? I guess that's it, right? Then at that point, I could lower the labor rate if I needed to. Now, the problem comes in where I get a customer that comes in and says, well, let's say I need you to discount the materials, right? So we discount the materials, but we don't increase the labor rate. At that point, we just gave away some of our profit. And there may not have been enough profit there to cover that discount that we gave. In other cases, customer comes in and says, hey, I picked this up at Home Depot or Lowe's. Can you put it in for me? What did we just do at that point? There is no markup at all. And if we don't change the labor rate, we are going to be in problem. In fact, if we're going to give away all the material markup, we have to increase the labor rate somehow to cover all that overhead within the company. It needs to happen. So there's a direct correlation between the material markup, because that material markup is covering some of our overhead in the company. And if we don't have that, we have to increase the labor rate to compensate for it. So that one plays a part in there. The overhead side absolutely plays a significant role. And so we have to factor that part in. Overhead is covering, again, it's everything in the company. And remember, there's two major differences that we have to factor. We have to do this from a cash flow perspective. And so one of those items that we talk about, I said that differences between cash flow and accounting. Right? Remember that your P&L is going to have depreciation on it. From a cash flow standpoint, we have to deal with the actual equipment replacement costs. I talked about with your equipment just a minute ago. Now, actual equipment replacement costs are typically 25 to 35% higher than the depreciation shown on your P&L. Depreciation deals with what we paid for a piece of equipment 2 or 3, 4 years ago. Equipment replacement costs will deal with what it's going to cost to replace that same truck 2, 3, 4 years from now into the future. Build that into our pricing. So we have to factor that one in. Also, loan payments. Make sure that we're accounting for loan payments. The entire loan payment needs to be in there. All right, so looking at those, make sure we have all of our overhead from a cash flow perspective. Everything coming out of your checkbook needs to be factored into that labor rate. And then the last item in the labor is absolutely profit. Now, the big fallacy is, and I hear it all the time, is profit's what's left over after all the expenses are paid. No! If you're doing that, you're shorting yourself. You're kidding yourself. The law of money states that any significant size budget can and will absorb every single dollar that you put toward it. If we're not planning for profit, there won't be any left. And oh, by the way, it's not profit until after you've been paid. Right? Many other company owners will say, well, really, my wages are what's left over. Right? It's the profit is my wage. No! That's the wrong way to look at it. Right? You need to factor that in. I ask at most every workshop that I do, how many of you had employees that made more money than you did? As a business owner, had more money or made more money. Correct that. How many of his business owners had employees that made more money than you did? Now, again, if the answer to that is yes, and it is way too often, then my follow-up is, was that by design or was it by default? And if it's by design, I'm totally clean with that. Right? I'm good. My pay structure, I've got team members that could make more money than I do, and I'm okay, because if they're doing it, they're working hard. They're quite honestly, the company is benefiting from it in a big way, and I'm good with that. More often than not, it's by design, and I know how it goes, right? We cut the check to me, and quite honestly, we'll put that in the top right desk drawer until we actually have some money in the checkbook that I can cash the thing. And then we get to the end of the month or the end of the quarter, and we got to pay the quarterlies, the withholding, and we're going, man, if I just let's just void out that check, then I don't have to pay the quarterlies on it right now, and I'll recut it later on when there's money left over. And there's never money left over. So, be careful with that one. You need to factor in your wages into the company, into your hourly rate as well, and it's not profit until you've taken that wage. Get into distributions, and you can get into the other stuff that happens with with the ownership of a company. I understand that, but your wage needs to be paid before you can consider it profit. And so, typical profit ranges, again, depending on the trade, 5 to 15% from a cash flow perspective, not a accounting perspective, right? And again, I am always looking for double-digit net profit from a cash flow perspective. That's my goal. That's what I'm shooting for within the company. Factor that into your labor rate, just like rent, just like any other overhead expense that you have. And then also with knowing your numbers is the piece here, which is the monthly financial review. You have to do a monthly financial review. And this consists of a couple of different items. Number one, your financials. Close out your month, if you will, right, by the 10th of the month at the latest. Right? To see a P&L that's 2 or 3 months old has zero value to me. I want to see what it looks like at the 10th. Get it as close as you can. I know that you can't. You're not going to close out every single job. But complete it as much as you can, and by the 10th of the month, you want to review it every month. Right? Go down the line. Why is that expense there? Right? Oh, this is insurance other. Right? We don't have another category. That means it was just misclassified. Let's clean that up. Right? Clean those things up. So review your profit and loss statement. How does it compare to last year at this time? How does it compare to last month? Look at your balance sheet. And, what am I seeing on there? What's changing? Do I understand what it's telling me? If not, I need to learn that. right? I see the line on the balance sheet for retained earnings. Do I actually have an account someplace where we're building funds for that? That should be there. Also, where do my payables look like? And what do my receivables look like? I want to review those every single month. In fact, if I ever review the receivables and see that, and unfortunately we deal with companies that a huge amount on the receivables. If your receivables ever hit 20% of your gross sales, you have a new job, and it's called collections. You are right on the edge of that cliff, just getting ready to fall over. You need to be collecting the money when it comes in. Review this on a month, and if you do it every month, what happens is it starts to tell you a story that you wouldn't have seen, wouldn't have understood, wouldn't have heard by looking at it periodically with old data. Look at it regularly, know what your numbers are. All right, so with that one, I've addressed some of the questions that came up during the live session yesterday. Let's move on to priority number 2. Number 2 is develop a cash flow budget. Remember, I said you have to run your company based on the cash flowing into and out of your checkbook. There are significant differences between cash flow and accounting. Your P&L will lie to you on a regular basis. Don't get fooled by your P&L. It can tell you you're making money even if you're not. In fact, most of you have dealt with the firsthand difference between cash flow and accounting at least twice a year. One of that is happening either now or coming up here in the next couple of weeks. We go sit down with our accountant and we kind of review the year and what can we do to minimize our taxes. And especially if you show that you're making money on your P&L, one of the things that they will tell you is, well, you better go spend some money. If you don't go, excuse me, if you don't go spend some money, you're going to get nailed with taxes. And many of us use that as an excuse to go out and buy a new truck or something like that. But does it make sense for us? Right? First-hand difference. Second time you deal with it firsthand is along about March 15th. It's tax time. You go sit down with the accountant one more time. And the accountant comes back and says, you had a great year last year. Here's what you owe in taxes. What's your mindset? You're thinking, well, wait a minute. If I made that much money, where is it? Because it's certainly not in the checkbook. So that's first-hand difference between cash flow and accounting. Cash flow deals with the real dollars flowing into and out of the checkbook on a daily basis, whereas accounting, quite honestly, is numbers on a page, and some of them don't even mean a whole lot to me. What's your cash flow? What's the money coming into and out of the checkbook? Right. Two major differences between cash flow and accounting. The first one is equipment replacement cost versus depreciation. The second one is loan payments. And so if we look at those real quickly, first off, remember again, depreciation deals with what I paid for a piece of equipment 2, 3, 4 years ago. Equipment replacement costs deals with what it's going to cost me to replace that same piece of equipment 2, 3, 4 years from now. And we build that into today's pricing. Equipment replacement costs are typically always 25 to 35% higher than the depreciation that's listed on your P&L. So right there, the P&L is underreporting your costs. Make sure you're factoring in equipment replacement costs. Second one is loan payments. Right? We asked the question yesterday. If you have a $500 loan payment and $100 of that $500 is interest, the other $400 is principal, what shows up on the P&L? The vast majority of you stated that it's going to be the $500. And again, first-hand difference between cash flow and accounting. It does not. If you have a $500 loan payment, only the interest, only the $100 in this case will show up on your P&L. Cash flow, on the other hand, will show the entire $500. You need to factor because think about it. What happened to the other $400? You would think that if it's an expense, it would show up on the expense portion of my profit and loss statement. So the $400 really wasn't an expense, right? The money really didn't come out of the checkbook. And so if I know where to go look, I can go to my balance sheet and I can see where it reduced my liabilities, but it does not show up on the profit and loss statement. And so quite honestly, at the end of the year, you have to pay taxes on that $400. Unfortunately, we've dealt with companies that have this loan out there, and they're itching to get this thing paid off. And so one of the things that they'll do is they get this big job and they get a payout that comes in, and they take all that profit and they throw it at the loan and pay it off. And now we get to the end of the year, and all that principal that we paid off is considered profit, and we have to pay taxes on it. And I don't have any money left because I used all the money to pay off the principal. You have to plan that a little bit smarter. Be wise about that part of the puzzle. right? So factor in all loan payments. The more loans you have, the greater the impact this is going to have on your overall profitability. Profitability from a cash flow perspective will always be lower than profitability from a P&L perspective. If I'm profitable from a cash flow standpoint, I'll always be profitable on the other side. Not necessarily the other way around. Let's look at this in a little bit more detail. If I come through here and I've got, my company, we're doing $800,000 in sales. And all materials cost me $320,000. My cost of labor is $160,000. This is from an accounting perspective. My depreciation on my P&L is $20,000 per year, and I've got $6,000 in interest that I'm paying on a couple of loans that I got. And then all other overhead expenses combined are $280,000. I finish up and I add all that stuff up. I get to the end of the year, I end up with a $14,000 profit. Was that a good year or a bad year? Well, if we look at the exact same company from a cash flow perspective, not accounting, right? This is my P&L. I'm going to look at this from a cash flow perspective. The exact same sales, the exact same cost of materials, the exact same cost of labor. But instead of $20,000 in depreciation, I've actually got $35,000 in equipment replacement costs. And instead of $6,000 on those 5 loans, the actual loan payment is $24,000. And then all other expenses are exactly the same at $280,000. Just those 2 items, those 2 differences between cash flow and accounting. I subtract that out, I end up with a $19,000 loss, not a $14,000 profit. That's a $33,000 difference. Do you have an extra $33,000 laying in the checkbook to cover that? Because it's coming for you. Now, the kick in the pants here is this, is Uncle Sam's going to go, hey, you had a good year. You made $14,000 last year. You get to pay us taxes on $14,000, even though your checkbook is sitting here at minus $19,000. That's a problem. So be looking at that. Be aware of that piece of the puzzle. Now, this also means that we need to put together a cash flow budget. And you need to have this in place. Now, putting together a budget, many people don't like it. That's a dreaded B word. We can't do that. Now, if we put together that budget, one of the things, again, a lot of people don't put together the budget. Let's start there, right? And they don't for a number of reasons. Number one, they don't because I don't know how. Look, I got into this industry because I like working with my hands and fixing things. I'm not into this number stuff. And there's nothing wrong with not knowing how. Staying there is a problem. You have to learn that. You're now the leader of this company. That needs to happen. The second reason is sometimes, how do I know what's going to happen next year? I don't know what's coming up in sales. You might not exactly know what's coming up in sales, but if you had a slowdown last year in January, February, March, and the year before that in January, February, March, and the year before that in January, February, what are the odds that this year is going to slow down in January, February, March? It's going to happen. Use the last couple of years to predict what's going to happen going forward and tweak it from there. A budget won't be exact. It won't be exactly what's going to happen. Things are going to change, but at least it's a roadmap. It's your meter to tell you if things are going right or going wrong. Right? And in some cases, we don't put together a budget because I don't want to know. Ignorance sometimes truly is bliss. If I don't know it, then I don't have to do something about it. Or it's going to be too restrictive. Right? So that tends to be a problem. If you put together a budget, a couple of items. Number one, chances are a budget will force you to understand the real cost of running your business, maybe even for the very first time. It provides a level of accountability. And quite honestly, it helps you make good economic decisions and plans the future. Most contractors just evolve. They don't plan, right? They get the phone rings and somebody says, can you, install this or sell me this? Well, sure I can, right? And then you hang up the phone and go, okay, how am I going to do that? And you figure it out later on. And now suddenly we're into a new revenue stream that maybe doesn't make sense for us. We don't necessarily make any money at it. Right? Put together a budget. If we look at the budget in a little bit more detail, a properly put together budget needs to have a couple of items. Number one, you've got to have, of course, their projected sales across the top. Right? Got that one. Next one, and this is a very simplified budget. Yours needs to be a whole lot more detailed, but just for purposes of the illustration here, I've got my total cost of sales. Now, cost of sales here is not just the cost of the job, but total overhead and everything lumped into that same thing, right? So selling here, cost of overhead here, and then we get to the net profit and loss for the end of the month, right? So I can see over here in January I'm making losing $4,000. February, losing $4,000. March, losing $4,000. And then we make 2 and make 10 and make 7, so on down the line. A properly put together cash flow budget then needs to have this last line on here, which is the cumulative total. Right? So I can see at that point, January, losing 4,000. February, I'm now at -8. And then March, -12. And then -10. And it's May before I hit a net 0 point. And June before we have positive cash flow. That's typical with every company. The only difference is when your slow points hit throughout the year. Now, I get to the end of my year, and I see over here that we've got, quite honestly, we finished up the year at +17. Now, you can put as many zeros on the end of this as you want. I don't care. It doesn't change the point. Right? So I finished up at a +17. Did I have a good year? Maybe, right? If I cleared that after I paid myself, after I put money aside for trucks, and after we paid all our expenses, I've still got that left over. Yeah, from a cash flow perspective, that's a positive year. But here's the thing. That +17 means absolutely nothing if I went out of business way back here when we were losing money. We have to be able to factor our way through it. Now, here again, where this starts to impact us in real life, I get down here, and we end up, I see in November, right about now, right, we've got +$20,000 in the checkbook. And our accountant's going to see that, and they're going, well, you better go spend some money, or you're going to get nailed with taxes. Should I really spend that? Because realistically, I see here, I've got a December with a -3, and then I got several losses that we got going on over here. Something's got to carry me through that. Play with you. Again, the accountant's going to deal with things on a year-by-year basis. You have to deal with things on a rolling 12 basis. Put it together, plan the cash flow out in your company. So again, we addressed any of the questions that came up during the workshop yesterday, so let's kind of move forward right into point number 3. Point number 3 is you need to have a business plan in place for your company. Do you have that business plan in place? What do you have? Where are you going? How are you going to get there? Now, again, the business plan, it doesn't matter how big or how small your company is, right? You can say, well, yeah, but it's just me. I don't need a business plan. Yes, you do. You absolutely do. What are you going to look like a year from now? What are you going to look like 2 years from now? What are you going to look like 5 years from now? And how are you going to get there? You have to plan that out. Now, you might have an idea here, but the thing is, here doesn't necessarily get done. There's something about writing this thing out and putting it on paper that starts to change the way you think about it and starts to bring action to it. Right? The old adage says, if you don't know where you're going, any road will get you there. You just don't know when you've arrived. Be intentional about the growth and about the movement of your company. Right, so the business plan is quite honestly going to set the direction of your company. Where are you going? It's going to spell out, again, how are you going to get there? What are you going to need in terms of additional resources, labor, equipment, cash, funding, any of that stuff? Think through some of those things. It changes the way you address it. Now, again, your business plan does not have to be 75 pages of single space, right? 5 major sections is all it needs. Right? And just think through these couple of items. The first section would be the executive summary. So this should be, give me the history of your company. Tell me a little bit about how you got to where you are today. What are those things that you've done throughout the history of the company that were home run? When you did it, man, you just absolutely knocked it out of the park. And what are those things that you did that, you remember that thing, right? That when you did it, it cost you, you're trying to forget it, I know. Right? It cost you a whole bunch of money, and it was ugly, and you vowed to never do it again. Right? What did you learn from that? Right? That's part of your history. That's part of what makes your company what it is today. What are the general market conditions? What's kind of the conditions, this particular market? How's it going today? Right? Who are my competitors? And which ones are the strong ones? Where am I weak when it comes up against those guys? And what are my goals? What am I hoping to accomplish? So be looking at those couple of items. Just simply spell that out. Right? Second major section needs to be the financial plan. Again, give me a history of the company from a financial standpoint. Maybe put in there a set of your current financials, the P&L, the balance sheet, right? All that information. Where are you at right now? What did your cash flow look like over the last year? What's your forecast for additional purchases that you're going to have to make? What's that going to cost you? How are you going to pay for it? Put together a month-by-month cash flow budget for not only the next year, but maybe the next 2 years. And you want a real challenge? Start to think about it over the next 5 years. What's that going to take? And these cash flow projections should not only include some of these other things that we're going to planning to to take on over the next year, but also some increases in sales and revenues. Those need to happen as well. So what does that look like? Now, again, they're not going to be exact. I get that, right? But make a projection. And if you need help with that, again, the labor pricing software tool that we have will absolutely help you walk through that process without a question of a doubt. The third major area needs to be your marketing plan. Right? How are you going to market things? How are you going to get the word out about it? Right? What are you going to do? What do you expect to see for the results, for the money that you're going to spend to make that happen? Right? What are you going to do? Who's going to do it? What's it going to cost you? Kind of lay that one out a little bit. The fourth major area, production needs. What are you going to need in terms of additional people or labor, manpower? What about materials or inventories that you're going to have to start to buy and increase a little bit more? What other major pieces of equipment? I'm thinking about adding on another service tech coming out here in another 2 years. Well, you're going to need a truck, right? You're going to need some tools for that. So how are you going to pay for that? Right? Factor that one in. And then the last section, the organizational plan. Now think about this. I challenge you to put together an org chart, but don't put together the typical org chart that simply says, quite honestly, I want to, the owner is here and this person reports there and so on down the line. That to me there's no value to that. I challenge you, put together an org chart driven around duties, around responsibilities, around things that have to get done. And who would this person doing this responsibility, who would they report to? What position? What other areas do they go to? Right? And then when you're all done laying that out, and it's much broader, then go back and start putting names in all the boxes. And you're going to find, quite honestly, that your name is in a whole lot of boxes. Right? And the same person's name is in a number of different boxes. The first time I did this, I found out there's things that I report to me on. There's other things that I report to my operations manager who reports to me. There's no wonder I'm tired when I go home sometimes, right? But the thing is, when it comes time to growing the company, at that point, now everybody in my company has seen this org chart. Think about it. If you just have the typical org chart and you lay that out and I bring in somebody new and I'm going to take some responsibilities away from you and give it to the new person, I don't care how much they liked or disliked that task, there's a piece of them back here going, wasn't I doing it good enough? Right, so it helps to grow the company as you move forward. And then what do you need in terms of training for both the office staff as well as the technical group? What are we going to need for that? Lay that stuff out. Think about it. So that's the next one. Fourth area, a marketing plan. Do you have a marketing plan in place for your company? You have to have this. How are you going to get the word out about what you're doing in the company? Because here's the thing, it doesn't matter how good your products or services are within your company. If nobody knows about it, it's just another product or service that nobody knows about. Value to it. How are we going to get that word out with it, about what we're doing? How are we going to market that? What's it going to cost us, right? Put that plan in place. Track where your leads are coming from. Now, it's interesting. Every time I talk about this with a group, one of the questions that I end up getting is, and I tell them, look, you need to ask every single customer how you found out about us. And I hear all the time, I've been dealing with this company for this customer for 10 years, and I'm supposed to ask them how they found out about us? Well, no, change it up a little bit. If it's a new customer, yes, ask the question, can I ask how you found out about us? If it's somebody you've been working with in the past, turn that up just a little bit, and maybe you want to ask the question, can I ask you where you went to look for our phone number today? That gives you some information, right? And if you're spending money on things that you never get people telling you that's where they went to, stop it. Let's go find something else that works a little bit better. Have a plan that's continuous and overlapping. It helps to minimize the slow times. Always be doing something. Don't stop. So many companies pull back when all of a sudden things go down. That's the worst time to pull back because quite honestly, everybody else is pulling back. And if you just maintain, right, then you look like you're doing a whole lot more. Now, one of the other things that I get asked all the time is, well, how much should I be spending on marketing? Well, one of those questions, one of those things to keep in mind, as a general rule, 4 to 5% of your gross sales is maintenance. That's just maintaining what you're doing today. When you see companies, say the car companies and some of those guys that are on all the time, and you see that ad on TV constantly, they're spending 9 to 10% of their gross sales. Where are you in that? If you're less than the 4 to 5%, then you're struggling because you're not even trying to maintain at that point. What are you going to do to make that happen? And don't get caught up with trying to do it yourself. Sometimes we do that to try and save money, but this is not what we do, right? We're good at our trade. We're good at HVAC, at electrical, at plumbing, at putting in pools and maintaining them. We're not marketing people. If we were, we'd probably be in that trade, not in this one. So get involved with somebody outside. They can probably do it better, faster, and for less money than what it's going to cost you if you do it. It might not necessarily be money out of your checkbook that you have to write out, but what money is not coming into your checkbook because of the fact that you're wasting your time doing this. Right? Think about those. Think about it holistically from that standpoint. And also, when you're talking about marketing, you need to know what is your unique selling proposition. What is your USP is what they call it in the marketing world, right? You do a lot of things right. Are you telling people about it? This takes me back to when I was going to college. We're doing this from Wisconsin. Here in Wisconsin, we had at one point the beer that made Milwaukee famous. Brewing company. Right? For decades, they were the number one or number two brewer in the nation. Today, they're nothing but a trademark owned by somebody else. But at that point, they were riding this huge sales wave, and the sales wave was all driven around one tagline. It's the fact that they were cold filter brewed. They were cold filter brewed, and as a result of that, their beer was richer, it was fuller, it had more body, it tasted better, it was set apart from everybody else, and it would set you apart because, quite honestly, it was cold filter brewed. Now, I went to school in La Crosse, Wisconsin. La Crosse is the home of Old Style Brewing Company. And as a starving young college kid, you figured out pretty quick you could pay 65 cents for a brewery tour. They serve free beer at the end. So our entire HVAC class would go on a brewery tour like 3 or 4 nights a week. Well, when you've done that all the time, pretty soon they get to know you. After about 2.5 months into this thing, we finished up another tour, right? In fact, one of the guys in our group actually started giving tours. He knew it so well. And so I walk into the tasting area one night, and I said to the guy behind the bar, I said, you know what? I've had every one of these flavors already. Today, I want one of the good ones. Why don't you give me one of those cold filter brewed ones? And he looks at me and goes, oh, you're kidding. He goes, we talk about that stuff here all the time, that cold filter brew. They talk about it like it's, it's richer, it's fuller, it's better. No, you know what? Every brewer in the state uses the exact same process. We are all cold filter brewed. We're all the same. They're no different than we are. They're the only ones who told anybody. What do you do? Don't assume that your customer knows your story. What sets you apart? Is it the fact that you're, factory approved or factory authorized, you're a dealer, you're NATE certified, you're, the ASE mechanic on that side of it, right? You're licensed, you're insured, right? Well, doesn't everybody have to be insured? That's irrelevant. Is everybody insured? No. Right? So part of that discussion with the customer should be, look, if anything happens to, while we're on your property, you don't have to worry about it. We are completely insured. Here's a copy of our certificate. You can see that. Everybody should be. Not everybody is. Be careful with other people that you're getting quotes from. Right? Think about that. We had 347 total cumulative years of expertise to make sure that your system is going to function exactly the same way it did the day we put it in. What are those things that you do right? Don't assume your customer. Think about it. How often, at most, how many times are you in your customer's home? Maybe twice? That's it. That's if you're doing maintenance. They know of you. They don't know your story. Tell them your whole story. Even if you've been dealing with them for 10 years, 15 years, you put in their last system, make sure you tell them. Right? It will set you apart. What are those credentials? What are the things that you bring to the table? You have a brand. The question is it a good brand or a bad brand? But you have a brand. You need to tell that story. You need to control the brand. So be looking at those couple of items. And then number 5, out of our top 5 priorities, number 5 is track the performance of your service technicians. We need to know where these guys are, how they're performing. Your service department can and should be the most profitable area of your company, bar none. Many times it's not because we don't track the performance of our guys. It should be the most profitable area in your company. And the service department has the ability to drive cash and cash flow and drive business in the rest of our company like nothing else. Think about it. Your technicians have more credibility with the customer than anybody else in the company. Anybody else out there comes out here You want to sell me something. This guy comes out here, he's here to fix my problem. And he's their trusted advisor. So, again, the technician has the ability, quite honestly, to set a comfort consultant or a salesperson up for success or set them up for failure, depending on how they handle the customer. Invest in them. Right? Track their performance. Right? Set daily goals and measure them against it. Your techs will never miss a goal that you don't set. Are you setting goals for them? They need to have them in front of them. They need to know what think about this for a minute. If you have a technician, you send them out to a job on a service call, and really at that point, what's your objective? What are you telling them to do? Think about it. What you're telling them is to fix it. Not fix it profitably, not fix it within a certain time frame, but just fix it. And for somebody who's a service technician, and I'm a technical guy at heart, for somebody who's a technical guy at heart, I've done my job well if I fixed it. Sometimes fixing it's not the right answer. Sometimes a replacement is the right answer. And so, again, measure their performance. The techs will never miss a goal that you don't set. So a couple of the key performance indicators that you need to track. A couple of those items, right? KPIs, we call them. Number one, revenue per billable hour. That is the first number that I want to be looking at. How much revenue are we bringing in for every hour that you're billing out? The first thing I want to look at. This will show me who is my most productive guy and who's my least productive guy, and which is the guy that I need to keep running service calls as much as I possibly can. Right? When you're slow, and it happens all the time, we're going to pull a service guy to go help one of the installers. Many times it's the tech that doesn't complain that gets pulled and sent over there, even though that might be your most productive service tech. I want to know how much they're bringing in for every hour they're billing out. What are the number of non-billable hours? Remember that non-billable time is your single greatest expense in your company. What are the non-billable hours, and what was their source? What was this person doing during that time frame, those non-billable hours? Were they driving from job to job? Were they doing paperwork in the shop? I hate that. Paperwork should be done at the conclusion of the call, still at the customer's home, right? Were they, cleaning the shop? Were they, goofing around, or we just don't know what they were doing, right? That you can't fix it if you can't measure it. What were they doing during that non-billable time? Callbacks. What's the ratio of callbacks for technicians? Filtered. What I mean by filtered is if I ran a service call yesterday and today you wind up running the callback, I should be pegged for that callback. I missed something, not you. Right? So that's what I mean by filtered. It needs to be filtered back to the source technician. And so callbacks should never exceed 2.75% of all service calls that a company runs. So at that point, what is it per technician? Going back to that source technician. First time completion percentage. I want to complete service calls the first time I go out there at least 95% of the time. If I have to go get parts or go get materials and then I come back, that's another service call that I can't run. It's another diagnostic fee that I won't charge. I wind up running into issues or problems at that point. It impacts the profitability of my company. I want to finish the calls the first time around at least 95% of the time. Now, I know with some of the trades, you can't possibly stock all the parts, all the components, all the ECM drives or circuit boards or pumps or whatever it is that you got. In those cases, if you service a lot of equipment where you have to run and get that percentage might go down to about 92. But know that it impacts your company. Which are the ones that you're using on a regular basis? Maybe that's what I need to keep on the truck. A couple of other key performance indicators. Underbilling. The average technician will underbill the customer an average of $20,000 per year. You think, well, how can that happen? Well, it's actually fairly simple. If you're on time and material, it happens one of two different ways. Either number one, we didn't account for all the materials that we used on the job, right? And sometimes you think, oh, that's just a 20-cent part. It's not that big a deal. When you sell 10,000 of them, it becomes a big deal, right? Account for all those little things as well. Also, labor-wise, they get there at 5 minutes to 10. They finish up the job at 5 minutes after 11, and they write down an hour on the service ticket. We just gave away 10 minutes of time. 10 minutes of time average on a call. The average service tech will run 1,000 service calls per year. When you spread that 10 minutes out over 1,000 service calls, you're dealing with somewhere around 350 to 360 hours at your normal revenue per billable that you won't get paid for this year. If you're on flat rate or upfront pricing, the same thing happens. Because at that point, if I actually perform 3 tasks and I only write down 2, we just shorted the customer. The average service technician will perform 3.2 service flat rate codes per service call, but write down 2.7. Shorting the customer. We're underbilling the customer, I guess, at that point in time. Right? So look at that one. And then sales leads. Nobody has more credibility, again, with the customer. The technician has the opportunity. They're seeing the system degrade. They're seeing when an opportunity is there for a possible replacement. Sometimes that's the right answer. And so I want my technicians to be generating qualified sales leads. And the goal there, the key performance indicator that I'm shooting for, is 12% of all calls that they go out on. If you just want to track old equipment, they should be able to do 33% of just whatever you consider old equipment. But the big bogey across the board is 12% of all calls that they go out on. That's the next one. On the maintenance side, and you should be doing maintenance work. That's part of what builds the value in your company. From the maintenance standpoint, I want to track what is the actual time versus the predetermined wrench time. If I said the service call should, or the maintenance checkup should take an hour, then I want them to finish it as close to 1 hour as they can get. I don't want them to get it done too fast, because then there's a perceived value on the part of the customer. And what are they skipping is the other concern that I would have. I don't want them to go over unless they get something for it. Right? If they take longer than that hour, I'm okay as long as they're getting something, right? They found a capacitor that was bad, they need to replace that, we're getting paid for the capacitor. I'm good with that. But if they're not getting anything, then they need to finish it in an hour. And so that brings me to the next one, is additional repairs and add-on sales, right? A technician should be able to generate $40 or average $40 in parts and pieces and add-ons, right? Whatever that is, right? Contactors, capacitors, thermostats, pumps, valve seats, switches, fixtures, whatever it is, right? They should average $40 per hour in add-ons per hour that they're doing maintenance work. Very doable number. And then also on the maintenance side is I want my technicians to be able to sell new maintenance agreements. They need to know the value of it. They need to be able to relate that story to the customer extremely comfortably and spell out the value to that, right? And so the benchmark here is they should be able to sell a maintenance agreement for 42% of those customers that don't already have a maintenance agreement. And that's a critical item there. It's not 42% of the calls they run. It's 42% of the calls they run where the customer does not already have a maintenance agreement. If the customer already had a maintenance agreement, they didn't even have an opportunity. So I'm not going to penalize them when they didn't have an opportunity. So that's the KPIs that we want to follow. All right. So again, address the questions that came up throughout the program yesterday, as well as a few that came up afterwards. Those are our top 5 priorities. Right. Number 1, know your numbers. Know where they shake out. Know what you need to be changing, be looking at within your company. Number 2, develop a cash flow budget. You have to run your company based on the cash running into and out of your company, not numbers on the page shown on your P&L. Number 3, have a business plan in place. Where are you going? How are you going to get there? What's it going to take to get there? Number 4, have a marketing plan in place. Doesn't pay to have products and services if nobody knows anything about them. And number 5, track the performance of your service technicians. Those are the top 5 priorities that you need to follow within your company. Now, if you need some help on any of these items, one of the resources that we have, I mentioned it a couple of times, is our labor pricing for profit software. This is a tool that, again, helps you project. It's not an accounting tool. It's not going to take the place of your accounting software. It's a planning and projection tool. And it's going to help you to look forward 12 months and plan the cash flow for the next 12 months. This will help you not only in putting together a cash flow budget month by month, it will help you departmentalize, find out exactly what your break-even rates are in each department, find out exactly what you need to charge per hour in each department. It will help you price out jobs that you do, whether they're labor-intensive or material-intensive, and make sure that you're still hitting the profit targets that you're looking for. Know exactly what you need to charge for maintenance agreements, and it will also help you track your billable hours. It's all about the billable hours. So that's a tool that's available that's there. Also, the Planning for Profit workshops. We use this workshop, again, we use that software tool in our 2-day workshops, and in there we actually help you build that financial model of your company. Now, we've got a couple more of these that are coming up this year. Some of them are already full. They're already at capacity. but we're in the process. We've added a number of new locations here just in the last week or so. And quite honestly, between now and next May, there will probably be 8 to 10 more that are on the schedule as well. Check the Grandy & Associates website for locations and dates of those workshops as well. And if there's any questions that you have after viewing this online class, again, don't be afraid to give me a call. Telephone number here at the office is 877-202-8891, or send me an email at billkinnard@grandyassociates.com. I got a number of emails yesterday. I like to see those. I'll absolutely reply back to you and help you out with that. And with that, that brings to the end our 5 priorities that you need to focus on within your business. And hey, make a decision to make it a profitable day.